Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me this afternoon, we have Gené Teare. She is Senior Data Editor at Crunchbase, and Jeff Grabow, USVC Leader at EY. We're here to discuss why we can expect to see funding for companies that can return capital, all the trends in Q4, and as well as 2025 outlook. It is great to have the both of you with us. Welcome to Trade Talks. And Gené, let's kick it off talking about some fourth quarter 2024 trends, because there are a lot of expectations as we get into the environment for 2025.
Yeah. So we've seen, broadly speaking, I spend a lot of time looking at the Crunchbase data to understand the global markets. And broadly, what we're seeing is funding in the fourth quarter. So far, we're not quite all the way through, has picked up over Q3. But broadly, what we're seeing is around $300 is what we expect, $300 billion is what we expect to have gone into global venture this year. And that's kind of neck on neck with what we saw in 2023, although there's been some differences between the years. And then obviously, if you go back to 2021, it was over 700 billion. So we've more than halved from the peak. But we're kind of on track to a little bit below what we saw before the peak. So it doesn't feel like venture at 300 billion is very off from we were before 2021. But obviously, there's lots of changes within the venture ecosystem, which I'm sure we'll discuss.
And there certainly has been. And Jeff, one thing that you noted is that going into the end of the year, it's about the haves and the have-nots.
Yeah, it's going to be an interesting scenario because, AI has been a big story for the past couple of years and has driven a lot of volume. And if you're an AI related company, you've been able to raise money easier and, very large dollar volumes. Just in Q4, we've seen 4 companies raise about $16 billion alone, which is going to help drive year-end results and push, 2024 into be an up year over 23. But looking out, if you're, the other thing that's very interesting is that, just about at the end of Q3, we saw just over 50% of the companies hadn't raised money in the past 2 years. And of those that did, only about 20% of them, only 3,300 of them has raised more than $20 million, which really isn't a lot of capital. So we will have a lot of companies coming into the market. And as Gené mentioned, 2021 was a high point. If you raised in 2021, the realities were much different than they are today.
Yeah, they certainly are. And Gené, do you think that's a function of investors becoming more discerning in terms of where they're allocating capital? It appears to be that operational efficiency and good governance versus growth at all costs are how investors are approaching this market relative then perhaps to 2020 and 2021.
Yeah, we've seen investors pull back massively. When I talked to investors about 2021, they were saying to us that if I didn't get in at the A, then I'd get in at the B. If I didn't get in, I'd get in at the C. Basically, every single stage went up. Most late stage went up the most, but every single stage in 2020 went up. And investors were just piling in. They were piling in, investing at a pace we'd never seen. What we're seeing now when you speak to investors is they're way more cautious. They're way more cautious about how much money they're putting in, what valuations they're putting at. But what's also been interesting in the data is that sometimes those round sizes haven't really come down, because if it's harder to raise the next round, you might need to put more money to work. And so whilst we've seen everything come down in this market from where we were, we've actually seen specifically more at seed and Series A, that some of those rounds have actually gone up since 2021 and even into this year, when we expect round sizes to come down. If you're going to invest, you have to invest with conviction, and you might, as a seed or Series A investor, decide to put a little bit more money to work in the companies that you're deciding to back. So way more cautious, but not necessarily down in those very early stages.
Right. And Jeff, you had noted that 3.7 trillion is tied up in over 55,000 venture-backed startups in the US. To me, that number needs to come back, certainly back down to earth here.
Yeah, it's a staggering number. And I think that, it's been a slow boil in that situation, because, in 2004, there was 5,000 venture-backed startups. And there's a lot of macro reasons over the last 20 years why the number has grown, but we've seen massive amounts of capital go in. And, we've seen, venture is a 3-legged stool. The ecosystem is a 3-legged stool. It's fund formation, it's fund deployment, it's liquidity. And we've had amazing fund formation. We've had remarkable deployment of capital. We've had very little liquidity. And so that gets to the number and bringing things back down to earth. We're hopeful in 2025 that with some regulatory changes, M&A might get back more on the table, and that there will be more IPOs, because that number really does need to come down, because what it has hit is the VCs in terms of having illiquidity. They need to provide liquidity to their limited partners. Paper gains are great, realized gains are needed, and we need to recycle that capital. In the past 2 years, I think it was 7 companies in secondaries alone dwarfed all IPO proceeds. And so we need to see more capital being returned through, the liquidity of companies, recycling of resources back, as well as companies realizing their potential and going public.
Right. Well, and Jeff, is it a question of quality versus quantity, right? I mean, does it necessarily matter the number of deals as long as the deals are quality deals?
Well, I think we need to, getting back to the point, we need to bring that number down of the venture-backed companies, and the ones that may not realize potential will be acquired for technology and people. And then the companies that will realize their potential will end up in the public markets. And I think both of that needs to happen, because the number is staggering and it needs to come down.
Yeah. Gené, what about the global funding environment?
Broadly, I think that, we saw funding come down, as I say, from sort of Q2 2022. And what's interesting when you watch the venture markets is they always take a little bit of time to react to what's happening on the public side. And so when the market started coming down in 2021 quite massively, it took a whole quarter and almost a couple of quarters for the venture markets to react. I think what's going to be interesting I think Klarna is a big deal. The fact that they've confidentially filed, they're one of the biggest names within financial services. And we know, when we track our unicorn board, there's more than 1,500 companies worth more than $1 billion, which are sitting on the unicorn board today. And most of those values were set in 2021 and early 2022. And financial services in that period was the biggest sector as well for funding. So I think there's a lot of companies sitting that have significant revenues that are still growing at a rate where you could go public. And so hopefully some of those companies are going to list in 2025. And I think just, looking at the M&A, a lot of analysts that I spoke to through in the last 2 years have always said, well, the IPO markets we know are going to be slow, prices are down, but M&A is going to pick up again because prices have come down and there's a lot of change in the venture industry. And we haven't seen that as much as you would expect. So I think the liquidity equation has been very slow. IPOs we all know about. There were only 7 venture-backed IPOs this year over $1 billion that were in the US, so very, very slow. But M&A has also been very slow. So I think those liquidity needs have built up over the last 3 years, and that's what everyone's waiting for.
Yeah. Jeff, you had mentioned the regulatory environment could potentially be more favorable. In what terms?
Well, I think, with the change of administration, we're seeing potentially an opportunity for tech companies to buy tech companies again. And it's hopeful that will happen, which will loosen up, some of the buyers that were not able to necessarily buy in the past. And then, look at what we've seen with what's going on in crypto in terms of what that means to the fintech market. So now with a change in, valuations, even just on Bitcoin, that could be a potential opportunity for more fintech companies to access public markets.
Yeah, it's interesting, Gené, because other strategists that I speak with as well, the general consensus is that this valuation reset needed to happen, not just in terms of multiples, right, but just in terms of how companies were operating and building businesses and working with their advisors in a way this was almost healthy to see this reset and kind of come back down to earth here. Were you getting the same sort of feedback?
Yeah, I think if you look at 2021, everything was up and to the right. So funding was up and to the right, IPOs were up and M&A was up and to the right. We had the sort of whole SPAC boom. So everything just seemed like we were on this train, and then it very, very abruptly stopped. And so I think everyone is much more focused on, getting their cap tables in order, getting their fundings, getting their valuations in order. And so I think there's much more realism about what it takes to go public. And what I've heard from companies is you need to have, or from analysts, you need to have a path to profitability. You need to have significant revenue. It used to be around the 100 million mark was a sort of measure. Now it's north of that. It's 200 million and even more, but also a path to profitability as well as a growth story. And so for companies to hit all of those marks, you have to be, it's one of these later stage companies that are showing growth on all measures.
Yeah. Well, Jeff, when you think about advising companies, and because there are a lot of investors out there that are sitting on this dry powder, how would you advise entrepreneurs in terms of choosing the right investors, the right partners, the right advisors, because it can be overwhelming. You're trying to operate a company at the same time as you're trying to raise money, whether it's through the private markets, public markets. I mean, that can be challenging, especially for entrepreneurs who are new at this.
Yeah, it's interesting because, well, first of all, it's selecting the right, getting alignment with investors. And we were actually just at a conference and did a panel on early stage fundraising, and one of the VCs we had on the panel basically said, "Hey, venture isn't always right at it isn't always the optimal asset class for you to be raising from," and which kind of surprised a lot of the people in the room. But you need to have alignment and understand what comes along with the capital, and focusing on getting back to basics from an operational perspective and growing the business, because you're going to need to have good, good operational metrics, good outcomes, because you're raising in a different environment than you were in 21. And whether, and raising money at the seed round has been a little bit easier from what we've seen. Actually, we've seen a lot of seed activity going into this market. And I think part of that could be from what we've seen going on in the AI boom.
Mm-hmm.
But so, thinking about that, running lean, it's very interesting. We've seen companies just scale so incredibly fast. But, getting back to kind of more on the lean startup side of, growing rationally and not rushing, and understanding and making sure you actually have solid product fit, market fit with your customers. And these are not false signals. And you need to be able to do that. And that will give good signals to the market and help make you more desirable and help you cut through all the noise of the fundraising environment. Because, there are 55,000 companies out there. A lot of them are going to raise money. There's a lot of noise, and you have to be able to cut through that to the investor base.
Yeah, you certainly do. And Jeff, you made a great point here where, the diversity of experience on the team is an important factor as well. Not necessarily playing to win, but playing not to lose. And I think that's an important lesson that has been learned, because you're thinking about risk scenarios first, right? And I think that was, part of that ethos might not have existed when it was growth at all costs. So in my mind, I interpret that as, a healthy revision and a more solid way of growing and moving forward. I mean, thinking more of it through the operational and, risk management end seems like a healthy step. And, from an entrepreneurial perspective, a step in maturing for your company.
Yeah. And just understanding that in the past, especially in 21, and actually for years before that, there was always the belief that I could raise more money in a market, actually, even at a larger valuation, without much results, because the market was so frothy. And those days are gone for most of the companies. And understanding that and realizing, when you raise, make sure that you understand, raise like it may be your last round, and understand that you need to show a lot for what you raise, because the bar keeps going up, especially for companies that are in the pipeline already.
Yeah. And Gené, when you think about 2025 trends, whether it's capital going into specific sectors or into specific funding stages, what do you think the trends could be as we kick off 2025?
Yeah, I think, what's been interesting is through this downturn, we've seen a lot of money shift. Everything's down, but we've seen a lot of money shift towards seed. And there's been the discussion that Series A has been a much higher bar and very difficult to reach. And now I'm hearing from people at Series B where the crunch is. And so But I think what's going to be interesting is venture is a lot of funds or seed funds that were started prior to 20 and 2021 might not be able to raise in this fundraising environment. And so I think that seed environment, I don't know if the growth of that seed that we've seen through this downturn is going to continue in the way that we've seen in 2023 and 2024, just because a lot of those funds are not going to be able to invest. But I think, in terms of sectors, what's been most interesting is obviously the growth of AI is not surprising, but there was a lot of discussion around concerns about how much money is going into AI. Is there a bubble in AI? We saw all of that this year. But in fact, AI in 2024 has grown over 2023. And in 2023 wasn't the leading sector. Healthcare and biotech was the leading sector. In 2024, it's clearly AI has been the leading sector. It's around a third of all funding is going into AI companies. We think that's even larger because if you think of AI weaving through almost every sector, even companies that are not AI specific will be utilizing or using AI. So AI is the leading sector, and I think it's even going to beat 2021 numbers, which no other sector is beating in terms of the amount of money going into the AI sector.
Yeah, and Jeff, that's a great point that Gené brings up, because when you think about where money is going to be allocated for 2025, the AI story, I mean, you can be an industrial, you could be a supply chain company, you could be retail, consumer, it's being implemented everywhere and there's different use cases for it. So it's almost as if it's helping to, widen out the breadth within the VC space for investing.
Yeah, and it's very interesting because, if you take a step back, normally we see boom bust cycles, and we've really haven't rationalized what's happened the last 5 to 7 years in the venture cycle, and we're off on another super cycle. And I believe that AI we are entering another super cycle. I believe, and a lot of people we talk to have kind of likened this to the 95, 96 timeframe with the internet. I think it's very similar. There are differences. I think because I think Gené has alluded to this a bit, is the internet was a consumer adoption story. AI is a enterprise adoption story. Enterprises and consumers adopt very differently. There is pressure from Wall Street to reap returns from investment. We've actually seen some of that noise in the system already, just from some of the AI infrastructure investments that have been made the past couple of quarters. But the AI stack is being built. It's just like the internet stack was built in the late 90s. Infrastructure always comes first. It tends to be very expensive. But we're also going to see something in the next 7 years or so when that stack will begin to collapse through technology adoption and technological advancement. And so it's just, I think over a long period of time, we're going to see things advance, but you could see some flash crashes over the next several years in some of the quarters, just because of shifts in what happens, and maybe the adoption isn't going as quickly as people would like. But I think long-term AI is a massive story, and will lead to great opportunities for the venture ecosystem.
All right. Appreciate both of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.